Hi, good day everyone. So welcome to today's webinar presented by PU Prime. So today's topic we will be focused on the FOMC decisions, which is the federal interest rate decision, and the announcement will be made by later today. We will discuss on several possibilities, what the Fed might going to do, and also the impact on the financial markets after the announcement is made. Before we start, allow me to read out the disclaimer. So today's Market Insight webinar is intended for educational and informational purpose only, and participants shall not take it as financial or investment advice nor a trading signal. The accuracy and reliability of the information provided cannot be guaranteed. PU Prime and I hosting the sessions are not liable for any losses or damages resulting from the use of the information presented today. Participants are responsible for independently verifying information and considering their own financial goals and risk tolerance. Okay, so let's get started. These are the things that we are going to cover today, which are the monetary policy decisions, and also we will refer to some of the economic data, especially the inflation one, and especially the US economic data, and also we will discuss on the implications on the financial market respectively. So before we talk about our main topic today, allow me to briefly explain the relationship of the inflation and also the monetary policy from the Fed, and also how does it impact on the financial markets. Okay, so it's like this. When will the Federal Reserve is actually the central bank for the US, where they can control the price of money, because we know interest rate is the price of money. So when will they step in to control the price of money is when two extreme things happen. One is when the economy went into recessions. So when they want to stimulate the economy, they will control the interest rate in the country. So if, let's say, the economics is in a downturn, they want to stimulate it, they will cut the interest rate as low as possible so that the money become cheap. Everyone can use the money in a cheaper manner. So gradually it will help to boost the economy. On the other hand, if let's say the inflation is very high, which is the case since last year, after the pandemic, when the government tried to help the economy, help the people to survive, they actually delivered a lot of stimulus package. And the aftermath effect for it is they resulted in a very high inflation. So some of the countries, some of the economies like the Euro, like UK, and also US, their inflation actually hits nearly to double digit, which is not good for the economy, not good for the people. Imagines that the goods and services become too expensive and people are actually struggling. So here also why the federal steps in. So since last year, March, the federal start to tune their interest rate. They slowly, I cannot say slowly, they quite aggressively raise up the interest rate in the US so that they're aimed at to control the inflation. So this is what I said just now. When in 2020 the interest rate was low in the US, because after the pandemic, people are struggling, so the government steps in, the Federal Reserve steps in, so to boost the businesses, to encourage more economic activities. So up until today, 2023, the interest rate has actually gone up to about 5%. So the current interest rate, the range in the US is 5% to 5.25. So why is it happens? Also adding that remember early last year, Russia and Ukraine, they have a war. So we know that when there's a war happen, the energy costs will likely to goes up. The oil price will be higher during wartime, and especially this round. We know Russia is one of the main exporter for crude oil. So when they involve in a war, and also in the Western world, they try to sanction them. So it resulted more expensive energy costs, and the crude oil become more expensive. So as we all know, because when we produce goods, a lot of things we need crude oil to transfer it to energy, and then to produce things. So when the energy cost is higher, the thing will be higher. The thing will become higher and gradually get into the hand of the consumer. It will be very, very expensive. So this is where the inflation happened. So when inflation happened, and it's not good for the government, people complain, so what they do is they try to raise the interest rate, and also, but now, as we all know, up until last week, we know that the inflation, especially in the US, is successfully under control, because we know the Federal Reserve have a target the target interest inflation rate at 2%. So but now the CPI reading is at above 3%, from I think more than 8%. So it's a huge improvement for the US government, but I think there's still way to go. So now we look at the current interest rate for the Federal Reserve. The latest interest rate will be at 5.25% to 5.5%, and market widely expecting that a rate pause from the US government. And also because the next interest rate decision will be made in November as well as December, after the September. So what the market speculating now is the Federal Reserve will choose to pause the rate hike in September, but maybe will add another round, increase the interest rate in November or December. This is the CME FedWatch tool. You can see over here about 99% of the participant, when they do the survey, they actually think that the Federal Reserve will not increase the interest rate this round, and only 1% they vote to the Federal Reserve might go for a 25 basis point rate hike. Why are people speculating that the Federal Reserve might choose for a rate pause? Is because the inflation in the US is significantly eased from, I think, above 8% last year, is already came down to above 3% last month, and also because the economic growth is still relatively sustainable in the US, because we can see that the PMI reading, as well as some of the other economic data and economic indicators, shows that the US government actually can successfully engineer a soft landing for the US economy, whereas the government continue to increase the interest rate at the same time, will allow the market to avoid from the economic downturn, because we know, like what I said earlier, when the government try to increase the interest rate higher, it means that the money will become more expensive. So when the money become more expensive, when the cost of borrowing increase, it's actually discouraging people from doing business, discourage people from spending, discourage people from investing. So this will, as a result, will slow down the economy. But seems like it is still not the case in the US, because even the Treasury Secretary in the US, Janet Yellen, has said she is feeling very good about US to make a soft economic landing without a recession while taming the high inflation in the US. So we can have a glance of the CPI reading for the US. We can see since the August last year, the inflation is actually has peaked, which is I think slightly higher than 9%. And ever since then, it's gradually came down. But if you look at this red arrow, you can see since July, there's a sign that the inflation in the US slightly pick up. So this is why people speculating that although the Federal Reserve is very successful in controlling the inflation since last year, because if you look at from 9% until 3%, it's like it's a very, very good result already. If you compare to the euro I think is still like 4% for the CPI, and also UK, the latest result is 6.7%. It's still very, very high, and all of them, they still have a favorable inflation rate at 2%, but only US is like touching the targeted rate. But notwithstanding of that, there's still some signal that the inflation in the US is slightly picking up from avoid the inflation to go any higher. So people speculates that the Federal Reserve might going to add another round of interest rate, maybe another 25%, maybe in November or December. But if you look at the US economy, since this is like a monthly US data, you can see that overall their economy is still good. You look at the crude oil inventory, it's a huge decline in their stockpile. The crude oil stockpile means the demand for the crude oil in the US is picking up. It's also from the side reflecting that the economic activity in the US is very good. It's improving actually. And if you look at the initial jobless claim, the reading is better than expected because it's less people claim for it. It means that the job data is good. The labor market is still very tight. When everyone has a job, this means that they have the money to spend. So when means that when the labor market is tight, means that the consumer spending will be good. And also the non-farm payroll as well as the PMI reading. If you have a glance in a general, you can see that the US economy is actually doing quite well despite the Federal Reserve increased the interest rate from 0% to above 5% in about 1.5 years of time. This is very aggressive. It's like they never done it before in the past. This is the first time they do it, but it is better than what the Federal Reserve expected because the economy is still good. So this is also, if you look at the economic data, you can also speculate that the Federal Reserve might surprise us later on, because I think if you look at the GMT plus 3 later today, 9 o'clock, the Federal Reserve will announce their interest rate decision. Despite what the market widely speculates that the Federal Reserve going to have a rate pause later on, but I mean there's still chance that the Federal Reserve might surprise us, might surprise the market, add another 25% or so to the interest rate, and of course it will rattle the financial markets. This is what I mentioned earlier. The CPI for the US is up by 0.2% from the previous reading of 3% up to 3.2% for the latest result. And also if you compare to the 2% targeted inflation rate, there is still a way to go. So, what will happen to the financial markets when when the Federal Reserve increase the interest rate? First of all, the direct impact will be the US dollar, because I say that interest rate is the price for the money. So when the Federal Reserve increase the interest rate, the direct impact for the US dollar is the US dollar will appreciate. The dollar index, the DXY, will appreciate because this is what's going to happen. But let's say if it's not the case, I think at the moment now, if you look at the chart, the dollar is actually quite strong. Is actually has keep moving in an uptrend channel. Yep. So I think since mid of July, after the DXY traded below 100 mark, but it's quickly responded and rebound, and then ever since it is now traded in an uptrend channel. But if you look closely now at the moment, before the Federal Reserve announced their interest rate, it is now traded quite sideways. Now it's like trading in a sideways, waiting for the interest rate decision to be announced later. So what will happen is, this is my own speculation, my own analysis. If really like what the market is expected, the Federal Reserve really going to post the rate hike in September later, I think anyhow the dollar will be still strong, and then at most maybe just have a technical retracement, but maybe I will still find support near 103.5 or 104. I don't think it will drop any further than this, because the global economic is still very uncertain. The outlook for the global economy is still kind of pessimistic. So we have to remember that the dollar is actually a kind of safe haven currency. And also, if you compare the US economy to other economy, you can see that the US economy is stronger than some other big economy in the world, namely the Euro, the China, Japan, and so on. So that it is easy for the investor to pick what currency they want to hold when the economic outlook is uncertain. This is a factor that why push the dollar index to be strong or sustainable at a higher level. And also another scenario, if later really the Federal Reserve surprised us, decided to raise the interest rate, I would say, yeah, the dollar will fly high, and at least will hit 105.5, and if it's very, very strong, maybe 106. And if this is the case, you know what's going to happen to all other pairing that against the USD. Those that against the USD will decline, and also the gold as well as the oil might also be impacted in a negative way. And the following things that will have a direct impact after the FOMC statement is released will be the gold. Let's look at the chart. Like I said earlier, because the gold price and the dollar will have a negative relationship. So when the dollar increase, it means that the gold price will drop. And now we can see that within these few days, the gold price is actually traded quite sideways also within a range, and it's currently have suppressed under a strong short-term resistance level. So again, if let's say the Federal Reserve going to post a rate hike, I don't think that will have a big impact on the gold market, because it is like a widely expected result. Investor has already priced in for this news. But if let's say the Federal Reserve surprise us, you can expect the gold can drop as low as 1920 because we can see there's a strong pivotal point about around here. Yeah, so at least if let's say really the gold price cannot hold above this range, drop further down, yeah, it will serve as a very solid bearish signal for the gold price later on. Yeah, and the next support will be at 1905 or 1900 1900 range. This is a very crucial psychological support level for the gold. Because we all know that the news in the past few days, because the US government is on the brinks to close down because they cannot get the consensus to get the government spending bill passed, and the time for them is only 10 days left. Before 30th of September, they have to get the bill passed. If not, there's another US government's closure. This has happened before, I think 4 times in the past. This might gonna happen again if they're not going to let the spending bill pass. If this is the case, you can fundamentally, this is not the technical analysis. Fundamentally, you will push the gold price to be higher. Yeah, because US government shut down, right? The third one that will have a direct impact will be the equity market. And the equity market will be the same as the gold. So when the interest rate is high in the environment, in a high environments, the equity market will be badly impacted, will actually drop or decline due to high interest rate, due to the Federal Reserve increase the interest rate. The reason also very easy. So when the interest rate is high, it is like it's like a risk-free rate. So if I put my money in the bank, I can generate, like in this case, above 5% of return. I would not want to risk my money in the equity markets. And another factor would be the cost of borrowing will be high. If the cost of borrowing is high, it's actually discourage the businessmen or the businesses from expanding their business. So this is also another factor why the equity market will be badly impacted. But at the moment, if you look at the Dow Jones, is still traded quite sustainable in a high level. But of course, now it seems like have a double top for the Dow Jones. So if let's say, if the Federal Reserve surprise us, you can expect the Dow Jones to actually continue to trade lower. But other than that, for the Nasdaq, if you look at longer time frame, if you draw a Fibonacci, it is still traded above the 61.8% this level. So it still means that there's still no trend reversal for the Nasdaq and also the S&P. The tax counter is still very strong. Now, this is the TA, but if let's say the news came out says that the Federal Reserve decided to increase the interest rate, definitely at the moment or on today, it will impact the equity market. The equity market will close lower. Okay. So we will wait for the FOMC statements to come out later. For this one is GMT. If you look at the GMT +3, so this is the time zone. If we use the MT4 or 5, will be at the 9 o'clock. For GMT +3, the US will announce their interest rate decision. Yeah. So here come to the end of our webinar. We will now open up for the Q&A. From Jim Jam, nice, no need risk-free when we can trade. Of course, when we trade, when we're expecting a higher return, but at the same time also come with a higher risk. But yeah, if people that are, they dislike risk, this is now a good time for them to save their money in the bank, and then enjoy, a 5% interest rate if you put your money in with the US. Yeah. How to trade gold short term. So if maybe we will go for daily candlestick. If you look at the daily candlestick, you can actually see that the gold price is actually now have a lower high, and lower high. So in a big trend, you can expect the gold to trade in downtrend, because also one thing is, if people want to go for a risk, a safe haven asset, the priority maybe people will go for the dollar, because if you hold gold doesn't generate you return, because there's no interest for it. If you holding the dollar is actually now generate you 5% of interest rate in return. So if you compare to these two famous safe haven asset, the dollar will have an upper hand. So that's why now in a bigger picture, you can see that the gold price now is trading in a lower low. It's like trading in a downturn gradually, but actually now I would say the trend is very uncertain. Like I said earlier, it is like traded in a sideways. So especially later on, we will have the big news that going to create a very huge fluctuation in the markets and also in the gold price. It will be wise for you to go for a breakup strategy. So if let's say the Fed's going to increase the interest rate, maybe you can open a position below 1928, and then, but of course now the market is very uncertain, so you don't risk yourself and then set a very far TP. You open a short position, okay. Maybe you can set a TP here at 1924, okay. And also because you asked for short term, right? And another one is the breakout, because you see that there's lots of candlestick over here, and when the market is very uncertain, we have like a dodgy candlestick as well around here, which is at 1935. So you also can wait for another breakup, a break above. So if break above, you can take a short-term profit, and maybe the TP also will be short. The TP, if you refer back to the previous chart, the TP you can set at 1939. You don't be greedy and you put your TP at 1940, or else if let's say cannot touch, then yep, you will lose up. Yes, risk management is very important. Before you make a profit, first you need to know how to protect your capital. Yeah. Any more questions? If no more questions, we shall end our sessions here today. Thank you for joining us. We shall see you